Hi, I'm research analyst Nick Antonucci, and I'd like to welcome you to Investments 101, a continuation of our MoneyWise Financial Literacy series brought to you by Henssler Financial. Today, we'll take a surface-level look at the types of investments that are likely most suited for the beginning investor and how to get started investing if you've not yet begun. It's never too late to start investing, but remember, the sooner you start saving, the more likely it is that you'll achieve your long-term financial goals. Now, the two most common asset classes for a beginning investor to consider are stocks and bonds. Stocks represent proportional ownership of a company and generate returns two ways. First, stocks can generate returns through price appreciation or when the stock goes up in value. Now, price appreciation occurs as a result of companies growing their earnings or on the expectation that a company will grow their earnings since the stock market is forward-looking. The second way that stocks can generate returns is from dividends. A dividend is a distribution of a portion of a company's earnings paid to its shareholders. Next, there's bonds. Bonds are issued by various entities, most commonly by companies, think Apple, the federal government, and local municipalities, like Kennesaw State, to fund their operations. A bond has a stated coupon or interest rate, which it promises to pay an investor at a set frequency for a defined length of time until the date at which it matures. At maturity, the bond will make its final coupon payment and return the initial principal amount to the bondholder. Beyond stocks and bonds, an investor can choose to allocate their funds to any number of other asset classes, which can include real estate and commodities. So how do you know what the right investment mix is for you? Well, your willingness to take risk, investment time horizon, and any liquidity needs will dictate the investment mix that is right for you. If you don't have the risk appetite to stomach a 20% drop in value, a portfolio of all stocks is likely not for you. Instead, you should allocate some of your assets to bonds. If you will need access to the money in a short amount of time, a portfolio of mostly bonds is probably the best option for you. By spreading your money across these various asset classes, you achieve a diversified portfolio, which reduces the volatility of your portfolio and will smooth out returns as different asset classes often move in different directions throughout the economic cycle. To illustrate the benefits of a diversified portfolio, take the Great Recession, for example. A portfolio of all stocks would have lost 51% during this time, while a portfolio of 60% stocks and 40% bonds would have lost just 31%. Starting out investing, it's often difficult to achieve a diversified portfolio as your assets are limited and the cost to trade individual stocks can become quite erosive to your portfolio. Thanks to mutual funds and exchange-traded funds, even a beginning investor can have a well-diversified portfolio at a very low cost. Both mutual funds and ETFs pool investor assets and allow individuals to purchase a diversified portfolio of stocks, bonds, commodities, or a mix for just a minimal fee. So how do you get started? There are countless institutions where a beginning investor can open an account with a minimal amount of assets. These include Charles Schwab, Fidelity, and TD Ameritrade, just to name a few. Most of these offer a select list of ETFs that you can trade at no cost, making it even easier for you to achieve a diversified portfolio at minimal cost. If you want to take an even more hands-off approach, seek out a robo-advising platform, which will ask you a series of behavioral questions and recommend an allocation based on your responses. The program will then invest your assets according to that allocation, making investing totally effortless on your part. I hope this has been a helpful overview of how you can begin investing. I'm Nick Antonucci. Thanks for watching.